All right, very excited. We've got Tim Coolman, who works for Edward Jones right here in Coppell. Thanks so much for coming in and being part of our class.
Oh, you're welcome. Glad to be part of it.
Yeah. So, okay. So you're a broker, you're an agent, correct? So you advise people on the kind of stocks and bonds and retirement accounts and all those kinds of things. Is that correct?
That's correct. That's right.
Okay, gotcha. So, let's say, for instance, a guy like me, 46 years old, I'm a teacher. I come in to meet with you, and how would you assess me? How would you know what to offer me, or how would you know, like, what direction to take me as far as planning for retirement?
Well, there's a whole bunch of different things that come into consideration when I help with clients, and what I'm primarily interested in is if you've got some money, what's the purpose of that money? Why are we saving that money? Are we saving it to buy a boat next year? Are we saving it to put money as a down payment on a house in a couple of years? Or are you saving it for when you're 65 years old and retired? What's the purpose of the money? I'm going to invest money for my clients differently for 0 to 2 years than I am for 2 to 5 than I am for 5 or longer.
Yeah.
So, retirement is a big thing to consider because, for example, the traditional retirement age of 65 in today's world with modern medicine, people live to be 100 or 105 years old. That's not unrealistic. I think that Yahoo came out a year or two ago and said the first person living to be 150 years old is alive today.
Wow.
So that would put a really strain on any retirement assets the longer you live. So we've got a plan for that. And the way that I do that is to manage the difference between growing assets and the risk that those assets present. So being able to do that is something that I help clients navigate.
It's interesting. I mean, and to get into their world a little bit here as teenagers, we talk about crypto, we talk about GameStop, we talk about AMC. Does that stuff just make your blood boil, or do you feel like there's a market for that, and that's a little bit risky? What do you tell a 16-year-old who's like, man, how great is GameStop?
Well, you can drive by the building over here in Grapevine and see their headquarters. And, GameStop at one point was really a well-run company. But, when you think about the majority of kids or the majority of people that play games, they're streaming games today. They're not going to a brick and mortar store to buy those games. And that's kind of like what happened to the videotape industry. From years ago, you used to have a videotape that you'd rent a movie and you'd take it back to Blockbuster or something. Well, those stores have gone by the wayside.
Yeah.
GameStop has some risk to it as a long-term investor if they maintain a brick and mortar business model. So,
yeah.
But there is a component to investment that does take a little bit of risk. It could be, the aggressiveness of Bitcoin or something like that. Now, I'm not a fan of Bitcoin only because the idea behind Bitcoin is the technology in the transfer of asset for a purchase of something.
Yeah.
That technology is really interesting, but Bitcoin is not necessarily the most efficient in terms of the technology that's out there and in terms of those types of transfers. Bitcoin right now, I like to buy something that has value to it. I like to have something that I can see the value or analyze the value. Bitcoin is pure speculation. You're basically buying something that somebody else says it's worth $50,000 a coin.
Right.
There's nothing concrete that substantiates $50,000 other than a group of people think it's worth $50,000. That's it.
Yeah.
That makes me nervous.
It does make me nervous too, but I'll tell you what, Tim, it's a lot of fun, man. It's like, if it's your disposable investment money, you feel like you want to take the spin on the wheel in Vegas. I mean, it's a daily, we track Cardona in my class just for fun. I bought it when it was, $1.35. And of course, people hold up these Marlin kind of investments that are like, look what I've done. And it's like, yeah, but you don't look at the other 20 that you missed on. So it's like, I don't want to hold one up and be like, yes, but it is an interesting thing, the volatility of it and just how much it moves. Man, my index funds are just not nearly as fun. They're much much more just very basic, so.
Oh, that's right. That's right. I mean, for a little portion of your money, it's fun to have that speculation because you get, you get to see the advances and declines and you're willing to accept the risk. But for most of your serious money, I wouldn't take that much risk with it.
Yeah. Interesting. And my wife, she works over at Sabre. And so
Yep.
we do max out her 401k with as much as possibly can do. Why is that so important if someone has a corporate job to max out that 401k?
Well, the 401k is important because a lot of times the company will match. There's two reasons why a 401k is really important. Number one, a company will sometimes match your investment up to a certain level. That's free money to you by the benefit of being a participant in their 401k plan. But secondly, when you think about income, you have to pay income taxes on your income. A 401k allows you to take a haircut of that income and put it in the 401k before it's taxed.
Yeah.
So it lowers your income overall, reducing your overall tax liability with the IRS, which is really a good idea.
Yeah. I mean, we've talked in our class about, Mr. Simpson, the teacher who has earned income, Mr. Simpson, the real estate investor who has passive income, and Mr. Simpson, the investor who has some kind of investment income. What's the difference between passive income and investment income? I mean, Warren Buffett has talked about how, he gets taxed at 13% or something like that. Is there a reason why he's taxed so low compared to Mr. Simpson, the teacher who gets taxed at 37% or whatever?
Well, Warren Buffett, the majority of his income does not derive from a paycheck. He does not have W-2 income. So that's where the majority of Mr. Simpson's taxes come from. If you analyze all his taxes,
right,
they're coming from, I got a cheat sheet that talks about what your tax bracket is based on what your income is. So the higher your income, the higher your tax bracket. So Mr. Buffett generally generates the majority of his income through capital gains. He buys something at 100 and sells it at 105, and that $5 is capital gain, and that's taxed at a much lower rate than what my income tax is taxed at.
Yeah. That's interesting because I tell you what, I finally got smart about 10 years ago and I got an accountant because I own a sports camp business. We own real estate. I'm a teacher. My wife's at Sabre. I mean, we have just a number of things where we're trying to, I've got an E-Trade account. I've got a, Robinhood account. We're trying to do some different things all over the place. We're just kind of spinning a lot of plates at once. And my accountant, believe me, earns every penny of what we pay her.
Well, you get the advantage of taking some of the tax law benefits to business owners by being able to apply a lot of expenses that you would have in a normal household to the business, takes it out of your income, out of your paycheck, puts it to the business and the income from the business, and you get to write off losses based on that.
Right.
Which is a great way for a lot of people to think about. You don't have to derive 100% of your disposable income from the businesses that you generate. But if you just have a little bit, you can write off your car and you can write off cell phones and some other things. Some of the other expenses do take monthly out of a portion of your monthly paycheck.
So you're saying my kids should have a job and a side hustle that they can claim as a business, which, I write my phone off. I write off all sorts of things that all go through my business. We write off, you wouldn't believe, my accountant's like, she goes through the list of write-offs, and my summer sports camp income, which starts here, it ends up way down here. And then our taxation on it is so low. And I feel bad because my employees who work for me, they get taxed first on the money that I pay them, and then they have to pay their phone bill. And so it's hard to, to quantify that. I feel bad sometimes as a business owner.
You can't feel bad because, when you're first starting out, you need that paycheck. You want to be able to, to go to the movies or do some of the fun stuff or buy your first car. Those things are really important. You need to have a paycheck to do that. But as you have the ability with additional disposable income and create a sports business or, rental income or some of those other things, that gives you the benefit to write off those expenses, which is a great idea.
And you as an Edward Jones, you're a business owner, correct? Like you own your own
business owner. That's right.
Is it a franchise? Is that what you own, or you own an office, or how do they characterize that?
Well, the work that I do is a straight commission type work. So anytime anyone wants to buy or sell something with me, whether it be life insurance, stocks, bonds, mutual funds, whatever it is,
Hmm.
that's how I generate income and put food on my table.
Yeah,
But I get to write off my expenses. I manage a profit and loss statement just like you do.
that's awesome. That's great. Very cool. Well, I've got some terms here, which let me find this real quick. Oops, I had it here.
It's been a
Hold
long time since I've been in college, so let me see if I can answer.
on. Let's see here. Yeah, I've got all these terms for you here that are some ones that oops, sorry, let me get this screen right. Okay, there it is. And what a great last name too. Coolman. I mean, there you go. I mean, that's what you want to be, you know. Nothing rattles you. You're cool, man. So
Well, that's right.
that's good. So a couple terms here that state of Texas wants us to go through. And I got to tell you, I mean, I know enough maybe to be slightly dangerous, but you know, some of this stuff, I get my brain in here. And I mean, does your average customer come in and want retirement and ask you about margin accounts? Is that a term you hear a lot in your office?
Well, uh, margin accounts are not applied to retirement accounts. So if they're talking to me
Right.
about retirement, margin doesn't come up. But
Right.
a margin account is an option that a customer has in an after-tax account. So I get paid $100. I've already paid taxes on that money, and I can put it into a brokerage account and invest it in stocks. The idea with a margin account, it's been around, since the beginning of the stock market, is that brokerage firms such as Edward Jones or Charles Schwab or Fidelity or E-Trade or whomever will loan you money based on your investment. So my investment is either cash or a stock or a bond. And they'll give me a portion of that investment as a loan. I have to pay interest on that loan because out of their goodness, they're going to make some money off of that loan. But I can use that margin amount to buy more stock. That's the incentive that the brokerage company provides. It's a way for them to make money, but it's also an easy way for you to be able to augment the amount of holdings that you have in order to generate more profit. You got a risk there because if the margin account is generally about 50% of stocks, if I have $1,000, I can margin about 500 and buy $500 more worth of stock. If that price of that stock goes down, I might be subject to a margin call and have to owe additional monies to that brokerage company.
So somebody could borrow money off of their existing stocks that they have in something in order to buy future stocks that may or may not go up. That just seems so risky, doesn't that? That doesn't sound good. That doesn't sound like a good system. Do you think?
Well, if you think about the overall stock market, I mean, the stock market is tended to trend up over time. So it's probably not necessarily a bad thing. You've heard the term buyer beware or invest wisely. I wouldn't use margin to buy something that's speculative. I would use it to buy something that would be a little bit more tried and true. It has a good balance sheet. An example would be something like Procter and Gamble. They make Tide detergent, Crest toothpaste, and Charmin bath tissue.
Yeah.
Regardless of what happens in the economy, people are going to brush their teeth, go to the bathroom, and wash their clothes. So something like Procter and Gamble may be a better bet than taking margin money to buy Bitcoin.
So you probably wouldn't want a margin to go get Dogecoin then. That might be a little too risky.
That's right.
For sure. So, okay, well, let's move on to the next term here. Options strategies. They're simultaneous and often mixed buying or selling of one or more options that differ in one or more option variables, call options, put options, bullish options, bearish options. Explain, what is this about?
Well, broker dealers give you the ability to be able to trade stock, and you can buy or sell a call or a put. Option trading is actually a very complicated and sometimes risky way to invest. And it would be really something that a very seasoned investor or a very seasoned trader would do, not a day trader. I would say that somebody that really needs to study the way call options or put options work. I can trade options on any individual stock, plus some additional securities. But what I'm looking at is the future price. I'm betting on the future price of a particular investment holding. So I might be buying a call option for a certain price, but that call is on the price of the stock coming forward. So what I'm looking at is, do I think that the stock price is going to go up or down? So I'm going to base my investment on the difference between the bid and ask price of that particular stock coming. So
it sounds
I
like
don't know a lot with option strategies because it's a risky investment strategy. Bullish options are whether or not you feel like you're going to see an increase in the value of the stock or the market. Bearish options are, a downward trend. I don't know if I can help a whole lot there.
Yeah, no. And by the way, the word that in the last thing you said that scares me the most is betting, because it feels like this is, I talk to my class all the time that I invest and I buy things and I have multiple streams of income because it helps me sleep at night. Like this kind of thing right here is similar to me feeling like I'm buying cryptocurrency or something. It just feels so speculative. It feels so much like I honestly don't, I guess you'd have to be really a really seasoned investor to understand some of these and even go in with option strategies like this. Is that right?
The strategies for options is quite unique because it's a metric that you have to think about all the time. I can buy or sell a call option, or I can buy or sell a put. And an easy way, I might buy a Nike or I might sell a Nike put for $15, and that's money in my pocket. It's an easy way to make money. But what happens to the future price of Nike stock could determine whether I make money or I lose money on my bet on my investment. So it really takes a lot of focus to determine whether or not this is a strategy for an investor to look into. It takes a lot to learn it, takes a lot to practice it, and it's not always successful even to the seasoned pros.
Yeah. So the next term here, I guess with my students here, they can think of hedge funds when it comes to GameStop, because so many of them were shorting GameStop back at the turn of the year, and it was like this. It was like hedge funds became the antagonists in every movie you've ever seen, and the Reddit people wanted to just bring them down. What is a hedge fund, and why does everybody on Reddit hate them so much?
Well, a hedge fund is a pooled investment, and it's really designed for sophisticated investors. And a hedge fund, matter of fact, I forget the guy's name. I looked him up, but it was created in 1949, and a guy by the name of Jones created the hedge fund, the first hedge fund. And basically what he's doing is he's taking people's money. Yeah. So I get, a hedge fund could be just about anything, but I'm going to have an investor. It's got to be in today's regulated investment community. It's got to be an accredited investor. So you got to either have $1 million worth of net assets, or you got to have annual income of $200,000 or more to be able to invest in a hedge fund. It's basically a pooled investment. Mutual fund is kind of like a pooled investment. But a mutual fund, I know what the investments that are underlying that mutual fund are. A hedge fund, not necessarily. The fund manager can use any of those option strategies. He can use forward contracts. He can use future contracts, options, whatever, to make his investment. He's incentivized on making a lot of money. So for example, he may get paid 2%. He may charge a 2% commission just to be in the fund, which could be quite a bit of money. But he may say, listen, if my fund makes more than 5%, I'm going to keep 25% of that amount over the first 5% as my compensation for doing a really good job.
Yeah.
So that means a lot of fund managers take a lot of bets. And their bets are the value of Tesla stock, because Tesla, if you think about it, is either a technology company or an auto manufacturer.
Yeah.
And there are two completely different viewpoints when you take those two sides to Tesla. The technology people are real excited about the technology that goes in the car. The car manufacturer, the car side of people like the car, but it's a good car. But which one of those are going to win out on the long run? So the technology is what some people feel like is going to be ubiquitous in the marketplace for automobiles. So they're going to short Tesla stock thinking, oh my gosh, it cannot be worth more than the value of Toyota.
Right.
So hedge funds tendly, think that they're going to make a lot of money when the price of Tesla or some other stock falls.
Right.
And they will make a lot of money if that happens. What happened with Reddit is that a bunch of people said, okay, well, we're going to, for fun, as it turns out, or as a personal grudge, we're going to buck the trend and take a whole bunch of people and try to drive the price of the stock up to take it to the hedge fund companies. I don't know why they became vilified, but that's what happened.
Interesting. Yeah, I don't think it was very fun for the hedge fund managers. It sounded like some of them really took a hit. I mean, that thing went up to almost $400 a share. So
it did. But hedge fund managers can make a lot of money or they can lose a lot of money. So that's why it requires an accredited investor to invest in them.
And you got to have $1 million of assets as an investor to even get into this thing.
You even get into this.
That's incredible.
An investor letter.
So now are futures primarily only on commodities, on things like coffee and, things like that are like tangible, or can futures be on anything?
Well, there's a lot of things that futures can be on, but the primary futures actually serve a purpose. And there's a difference between futures and forwards. Just to give you a quick comparison, a forward contract is, I'm an airline and I believe that the price of jet fuel is going to go up in the future. So I'm going to buy a forward contract to deliver to me X million barrels or X million gallons of jet fuel at this price. If the price goes up, then I saved a whole bunch of money. That's a contract. Futures kind of work the same way, but they can be on a bunch of different things. They're primarily traded on commodities, but they can be on, treasuries and any of the precious metals that are out there. But generally what they're on are on commodities that have a marketplace, because they're controlled by the commodities. It used to be the CBOE, but it's now something different. But it's on something that has value in the marketplace today.
Right. Interesting. And companies have to be able to predict to some degree what their costs are going to be, right? Is that like American Airlines needs to kind of know what their jet fuel is going to cost. Starbucks needs to kind of know what their coffee beans are going to cost, right? To be able to assess prices in the next year or two.
Well, the futures are probably a little bit more speculative than forward contracts are. Forward contracts are a derivative of futures that companies actually enter into. The futures that we're looking at here are more of a way to speculate in the market. So I'm not, if I buy USO, for example, is a good way to look at oil. And USO at the beginning of the year really had a meltdown because the price of oil fell below $25 a barrel.
Yeah.
And it was USO is a derivative ETF that bases its price on the future price of oil. So
Right.
it's a future contract.
Okay.
And that's a way for individual investors to buy oil. I'm not buying oil with the expectation that I'm going to have 1,000 barrels of oil delivered to my driveway
Right.
when that future contract
It'd be hard to
ends.
store, you know.
It'd be hard to store. So I'm using futures as a way to speculate with my money on the future price of, say, orange juice. I think that oranges are going to go up because there's going to be a freeze this year, really hard freeze in Florida because of climate warming or climate change. So I'm going to bet that, matter of fact, this is going on in France right now. Wine is future because of fires in vineyards. The future price of wine is expected to go up. So if you're a wine drinker,
Yeah,
Mr. Simpson, you may want to buy your wine today rather than wait till next season to buy it.
interesting.
But futures are a way for us not necessarily to buy the contract, not necessarily to buy the commodity. It's a way for us to speculate on the future price of the
Well,
the
and I guess you got to be a weather forecaster to kind of figure some of these out, or just have a hunch, or the price of avocado or the price of whatever. Or try,
That's
I mean, that's
exactly
got to
right.
be
Coffee
such
beans are
a
good.
risky proposition,
It is. It's a way to look at risk.
Yeah. Now, recently I've been getting the prospectus on some of the different stocks and stuff I have. And honestly, I know this is a prospectus is sent to an investor to kind of tell us about the company, whatever. But honestly, do people actually ever read these things? Is this like, am I as an investor supposed to get in and read this thing and really understand this company? Or can I just go on my Facebook app and understand how Facebook's doing? Is that the better way to assess that company?
Well, I would, if you really want to fall asleep, reading a prospectus is a good way to do it.
Right.
However, as I said earlier, buyer beware and invest wisely is always a good thing. And the best way as an investor is to understand what it is that you're buying.
Right.
I like to look at the balance sheet. I'm more of a fundamental investor than I am a technical trader. The technical trader is the one that looks at the 200 moving day average and is it above or below. What is the volume that comes into the individual investment? I'd rather look at the underlying fundamentals of the company. How much cash they have, how much debt they have, how experienced is management, what are some of the risks that the company is aware of. They disclose risk in the prospectus. Matter of fact, it's generally in the first several pages. That is a big thing to help you understand what the business model of the company is like, or the investment that you're looking at, and understanding the risks that they're facing as a company. Warren Buffett loves to read prospectuses of the companies he has. Matter of fact, Warren Buffett created the moat system on investing, and he did that based on what the prospectus says. He's looking at risk, he's looking at competitors, he's looking at how well positioned that particular company is in the marketplace, and whether or not their moat is wide or narrow. And what he meant by moat is, are they able to dominate the marketplace? Facebook is a good example of a company that has market dominance. Google would be another, Amazon would be another. So those type of things are what you learn from reading the prospectus. I encourage people to pick up a prospectus, try to read through at least the first 8 or 10 pages of it, just to gather a little bit of understanding about what the company does.
just maybe make sure to have some strong coffee while you're reading it, as you can. I mean,
I have to.
they come to my Yahoo account, and I open them up, and I'm looking at these things, and I'm just like, I mean, it's almost like it's like someone's shining a light in my eye. You're just trying to read this thing. It's just so complicated. But I could see that if you're an analytical guy and you know, you're Warren Buffett and you like this stuff, and you're looking at all the nuts and bolts, like it's gotta. I mean, he's probably got to dig in. That's why Berkshire Hathaway's done so well.
Well, pharmaceuticals are a good example. We've been talking a lot about the COVID vaccine lately. I mean, you got Moderna and Pfizer. They talk about in their prospectus some of the things that they've got coming forward.
Yeah.
I mean, you're not going to read that on Yahoo News until unless, you know, they enter a particular stage or trial for their product. You're looking at their pipeline.
Yeah.
Prospectus gives you an idea of what the company is doing better than anything else. You got to trudge through it. It's not easy to read, but it does have a lot of good, useful information.
So just, you know, one quick question. I know I've got to go and you've got to go. One quick question though. Let's say I've got that 17-year-old kid in my class. Let's say he's 18, so he can invest on his own. He's 18 years old. He's working at Chick-fil-A. He has $100 extra per month that he would like to put away, and he's thinking he's not going to touch it till he's 65. What's the vehicle of choice that you would say, hey, this would probably be the best place to put it?
Well, I would say that putting $100 into something like S&P 500 index fund or a NASDAQ index fund. Matter of fact, there's some technology derived index funds that would be good. It gives doing something like a fund, whether it's an index fund or a mutual fund. An index fund is made up of a bunch of underlying investments, same way with a mutual fund. But the index fund probably is more focused in something that over time should return well. But I think the average return of the S&P 500 over the past 40 years is around 12% per year. It's a good way to, you know, make some money.
Yeah, and we just
might have periods of time that it trades flat, but over time you should make some money.
Well, and we just talked in this week about the Rule 72, about compound interest. I mean, it's blowing their hair back. I know index funds are not always, you know, maybe the most sexy investments or whatever, or the most, you know, fun like crypto or GameStop. But it's, you know, but it's the sound investment. It's the long term. It's boring, but it's gonna have a track record. Well, Tim, man, I really appreciate you. I really appreciate you coming in and talking to the class, helping us with some of these terms. Because you know, I looked at those and was going, oh boy, I better find myself an expert here to help me walk through. So.
My pleasure. Anything I can do to help, just let me know. And good luck to you and your class. Good luck. All right.